So by way of introduction, I'll mention that following his graduation from the University of Virginia, Chris's life and work has been steeped in technology. Interestingly, he began his career as a technology reporter for CBS News. I did not remember that from last year. He's authored 4 books. He's a self-taught programmer. He co-founded an iOS development shop called Sneakers Digital Agency. So someone's got to ask a question of what is Sneakers Digital Agency doing, but I'll just feed that out.
Sure.
He holds 1 provisional patent, and 2 years ago, he co-founded Iterative Capital Management with Rankin. Now, between the two, you might view Brandon as the traditionalist. I'm not sure if you two would agree with that, but I'm just throwing that out. Brandon grew up here in Houston. He earned his law degree from Harvard after completing his undergraduate studies at Brown. His legal work includes stints with Wilmer Hale and Gunderson Detmer, who is a huge name in the VC world. Then served as chief operating officer of Metamorphic Ventures, an early-stage venture capital fund, before joining Chris to launch their firm. So that's the background. So we've asked Chris to take 20, 30 minutes to, with a prepared presentation, get the discussion started. Then he'll sit down and join, and we'll go into a Q&A. So I've got some questions I want to get started with, but I'd say as you're listening to Chris, please begin to think about your questions, write them down, feed them up, and we'd like to have as much Q&A as you would like. So with that, Chris.
Thank you very much, Bill.
Let's get started.
Okay, can everyone hear me all right? Okay. Let's move forward. So as Bill said, I think the thing that everyone wants to know is, do we actually have to learn about cryptocurrency, or can we just ignore it? Unfortunately, you do have to learn a little bit, but there's not as much to learn as a lot of the consultants or marketers would have you believe. This is not a whole new universe. This is in many ways an incremental improvement on many, many foundational human technologies we already use every day, like accounting. But there are some sort of surprising and counterintuitive characteristics of this asset class that I want to talk about today. So you guys know about me, thanks to that kind introduction. I think the first thing to do when looking at cryptocurrency is to try to distinguish what's propaganda from what's actual technical edge. Generally speaking, so first I'll just sort of run through some definitions. You've probably heard a lot of these names before, but I want to kind of set the cast of characters so that we're clear moving forward. These are called public blockchains: Bitcoin, Litecoin, Ethereum. This is free software that nobody owns and no one's patented. The projects, to the extent that they are ongoing and continually developing, are managed on what's called an open source, open allocation basis. Open source means that anyone can commit code, although the people that administer the project don't necessarily have to use that code. Open allocation means there is no company that is the organizing force behind these networks. It is a group of, many groups of volunteers. Most of these people are highly, highly educated. They have high-paying engineering jobs at some major firm, whether defense contractor or Google or whoever, and this is what they do sort of on their spare time. That's going to become important. The governance structure is going to become important later. That's why I pick on that in the first slide here. So what do they do? Well, they're programmable. They're a lot like many of the real-time gross settlement systems that we use in the central banking system, whether it's Fedwire or SWIFT. However, no one can really succinctly tell you why you need an alternate to those networks. There's also this phenomenon of what we call crypto assets on public blockchains. This gets a little bit into the ICO phenomenon, which you may or may not have heard of. ICO stands for Initial Coin Offering. It's a play on IPO, obviously. These are people who are essentially issuing unregistered derivatives on top of a blockchain currency. Blockchains have currencies. We'll get into that more later. And they're selling them sort of like shares. And the idea is that if this product or service explodes in popularity, that presumably your little script, your little coin, is going to be worth more. It's a specious argument at best for most companies, although there is a case to be made for utility tokens, which are something like casino chips. I think we're all sort of familiar with why casinos use chips instead of cash. There are certain circumstances, like a subway system, where it does make sense to have a script, but again, they're highly limited, so this is not going to be a universal innovation, I don't think. You're not going to have these things for your parking lot at work or anything like that. But there is something interesting in terms of the fundraising mechanism. I've spoken to a lot of investment bankers that would like to know how they can bring this model of financing to their clients, and the answer is just break a bunch of laws. But there are people who are registering securities, and I call these crypto bonds. I'm really interested in these because instead of trying to make the coin a security or make the coin an object of speculation, the people that register these securities, they make the security the object of speculation. And the security is like a bond in the sense that it pays a coupon denominated in the coin of the network. So now you actually have something like a monetary policy system, right? When you introduce bonds, you're taking liquidity out of the system. So I think there is something there, although again, no one's really found a reason to do this. And then lastly, there's DLT, which this is what you'll hear from Microsoft and IBM. They'll tell you that this is a new type of shared database and that you don't have to trust let's say, your supply chain partner or some other vendor, some other stakeholder in your ecosystem. That you can all do sort of trustless business this way, but what they fail to mention is that you all have to trust IBM or whoever builds that system. So, right away, I want to touch on a sort of a contradiction here, which is that the most trusted, in quotations, trusted enterprise software companies are actually in the worst possible position to make a trustless system. So a lot of the things that are kind of confusing about Bitcoin, Ethereum, these networks, is rooted in the fact that no one owns them. Like I said, no one really operates them. It would almost seem like no one has skin in the game. But actually, it's sort of the opposite. Everyone that uses the network almost immediately has skin in the game. Just to join the network and transact requires a little bit of work and a little bit of cost. But again, I think these things will become useful in certain supply chain contexts. I'm not an expert on supply chain financing, but I understand it requires a lot of collateral. That collateral could probably be reduced if there was a trustless system in place. So why is this important? Well, I think if anybody in the room has a software engineering background, they know that sort of software engineers sort of exist in a culture of automating work. They're the laziest people on earth. I mean, if they could program a robot to feed them, they would, and I'm sure that's coming. But the idea here, the reason that this is exciting is that people want to automate business logic. They want to automate payment logic. And the primary motivator for that is the IoT. So critical to automation is having physical robots or physical objects or cars or medical machines that do your work for you, or at least support your decision-making process such that you don't make silly errors. It would be really nice if, in addition to supporting your decisions, some of these autonomous entities could also spend a little bit of money up into a certain threshold. So the example that I like to use is if I'm here in Houston from New York today and I don't have, maybe my cell carrier doesn't get very good service in Houston, ideally my phone would just rent a little bit of cell bandwidth or Wi-Fi from this hotel without me having to orchestrate a user password or a guest code and all that stuff. So these are again, not life-changing improvements if you talk about them on a use case by use case basis. But there is a lot of enthusiasm in Silicon Valley and increasingly in New York for the ability to automate this sort of business logic. And it also, it remains to be, or it doesn't need to be said that privacy and security are increasingly problematic in our existing legacy environments. So whether it's Equifax or Target or Sony, I mean, almost every Fortune 50 company seems to have been hacked by now. So at some point, this will hit enough people close to home, enough people will have a friend or family member who's had their identity stolen that they're going to start to really care about their personal data. Right now, I think people still don't, and I think that's a mistake. So it's something that we hear a lot is, well, if this just gets big enough, the government or whoever will just come in and squash it. That's possible, but there are barriers. So as I was saying earlier, a lot of these cryptocurrencies are free and open source technology, and these are generally mined. The coins are created through mining. Now, what is mining? Well, in a system that's decentralized, if you submit a transaction to the system, who processes it, right? If there's no central transaction processor. The answer is that transaction floats out into a pool, and it is picked up by the nearest, physically nearest mining node. And that node will, or a validating node, and that node will validate the digital signature on the transaction to see that it is a valid transaction. And then they will send that transaction to the nearest miner. And that miner could be in the same building or the same house or office as the validating node or not. It doesn't actually matter. Machines can come and go from the network at their leisure. You don't need anyone's permission to run the Bitcoin protocol or any of these open source protocols. You can simply attach a machine, and if it's configured correctly, it'll join the network, it'll start contributing computing power, and it will help essentially secure the network. It's secure that when people do send transactions, that they're processed quickly and correctly. This is not a legally contentious process. This does not, the Howey test is not a gray area for people that mine cryptocurrencies because you're actually doing work. You're setting up the machine. It requires some expertise. And generally, like, liquidity is managed the same way Forex liquidity is managed or regulated. So you have to be a regulated licensed money transmitter, money services business to buy and sell these things in large lot sizes over the counter. But generally speaking, the proof of work mined currencies are not a regulatory mess. These private permission blockchains, though, they are, because essentially, if you own a blockchain, if you create a blockchain, you and let's say 3 of your other corporate partners, you have a little blockchain consortium now. Well, these coins are essentially just instantiated by you or your IT staff, and it's essentially the way to get them into circulation at that point is to sell them or to give them away. And if you're selling them, that becomes, and again, I'm not a lawyer, but that starts to get into sort of legally dubious area. The other problem with private permission blockchains is that to the extent that they can be trustless, to the extent that you could operate one of these private chains with other maybe even competitors in your industry, you would need some kind of consensus mechanism to ensure that no one is falsifying data on their end. So if you can imagine that the nodes in these networks are fully redundant. So as I've said, there is no central repository for data. A full copy of the ledger is held on every single machine in the network. And that means that in order to see if a transaction is legitimate, a single node on the network just has to look in its local database and see, was that transaction in my ledger? If it's not, then it's not a valid transaction, and I'm going to throw it out. So for nodes that try to keep an incorrect version of the ledger, the nodes are constantly comparing, and they'll boot that node off the network. So if 99% of nodes, or if actually 51% of nodes think the version history is this, and 49 think it's that, it's the 49 that are wrong. So in order to compromise this system, you would have to just spend billions of dollars on computing hardware and energy. And of course, the joke is that once you've done all that just to attack the Bitcoin network, you'd make much more money if you just mined Bitcoin. These private blockchains don't involve any of these economic incentives or disincentives, and that's why they are sold in the marketplace. That's why they are kind of marketed like traditional financial products. And it's also why they require kind of a specious, what we call proof-of-stake consensus mechanism to keep everybody honest. No one has really been able to make proof-of-stake, what we call proof-of-stake, function properly. Bitcoin, the mining process, is known as proof of work, where you're actually expending electricity and paying for that electricity in order for your computer to do work that earns you coins. And there's, how that turns into value has to do with cryptography, and I'm happy to explain it if anybody's interested during the Q&A. But in any case, I mentioned this to sort of make the point that corporate blockchains are really not that exciting, but they do get marketed a lot more, and so you'll probably hear more about them than something like Bitcoin. So I sort of went over this already. Liquidity, in terms of the publicly mined cryptocurrencies, is regulated a lot like Forex or other commodities. We don't really have clear guidance on whether ICOs are a legitimate financing mechanism. The SEC has said, actually many people within the SEC have said sort of conflicting things. Some people have said these things are all securities. Some people have said, no, there is a narrow use case for utility tokens. We're just awaiting more clarity. So the other thing about ICOs is that you can already crowdfund fairly effectively, right? We've all seen Kickstarter. Many people don't know, but the Jobs Act has a crowdfunding license called Title III. Instead, people have been using what are called SAFT notes, which are a standard agreement for tokens as opposed to a standard agreement for equity, which comes from Silicon Valley, the SAFE note. SAFT notes are also securities, so it's really unclear what happens once you get those tokens and then you resell them. Are you breaking the law? But for the purposes of this talk, I think we should stick to cryptocurrencies and mining because it's really clear, at least from my technical standpoint, not being a lawyer, how we can move forward with this technology. So I've talked a little bit about why you should be skeptical of these, but I should be fair to them and say there are going to be use cases, albeit limited and extremely large scale. So I think it's one of either MoneyGram or Western Union that is actually working with Ripple to test cross-border remittance. I think there is going to be a use case here. I think it's IBM is working with Stellar, which is another private blockchain. But again, this is not probably going to be commonplace for people, at least in the US. And I've sort of mentioned this. You'll see probably a lot of really appealing quote-unquote ICO investments. They'll tell you, we're bootstrapping a new network. They'll tell you we're building a consortium. They'll put whatever on a blockchain, dog care, or who knows what. So these are some of the fantastical claims that we hear regularly. Probably the worst one is that this is a channel for consumer engagement. I mean, you couldn't get a more confusing process than sending and receiving cryptocurrency tokens. And again, a lot of these tokens, their price floats in dollars. So if you denominate your service in a coin that you issue and the price is floating, your customers are always paying a different price. They're always doing conversions between dollars and coins. That's really not, I don't think, the future of these networks. And again, if it's not free and open source, we're generally not interested in it because in case people don't know, the foundation of the World Wide Web is free open source technology that no one owns and no one builds for profit. So probably 90% of the web servers on Earth run Apache, which is free open source software. They also run Ubuntu Linux, which is free open source software. These software projects make up the base layer of our digital existence, but we never think about them because they're not advertised to us and we don't have to buy them. They're essentially used for free by the corporations on the application layer like Google and Facebook. Every major enterprise software company has a team of people in-house that just commits to free open source projects that they don't profit from, which can sound counterintuitive to people from other industries, but that's the case in software. So what's the impact? If cryptocurrency continues to grow, if it continues to kind of tickle the brains of software engineers, particularly the younger ones, who don't love the idea of working on somebody's, some old guy's legacy system for the rest of their life, I think what we're going to see is a lot of experimentation. This is the first really self-funded open source financing mechanism. So I mentioned Apache and Linux. They've made their progress entirely by donations. A lot of donations from big corporations, granted, but still donation-based. And that makes it, donation-based progress is always harder than if you have a financing mechanism sort of built in. So what this does is it sort of allows engineers who are in the position to evaluate a network to join it early on. They'll set up some mining machines. It's when a network is young, it's very easy and quick to earn coins through mining. When a network is mature, like Bitcoin is now, it's very, very expensive and requires a lot of kind of overhead capital expense to set up a mining operation. But I think of this as sort of like a pure software postal service where you have, the postal service was useful before digitization for just transiting information around. But the postal service also had banking, still has banking features. You can bank at the postal service. You can even use coins as a form of script, or excuse me, stamps as a form of script. And people used to do this in the 19th century. So to the first speaker this morning's point, I think we're in very early days of the internet. The internet is such a backwater that it didn't even really have its own postal service. We had email, but email is more of a spamming mechanism. It's more like roadside billboards. It's very easy to get people's attention through email and not have to pay anything for it. Right? Spam mail is a huge problem. In these networks, everything is controlled by incentives and disincentives. So to spam the network in this world, you have to pay to spam the network. And as I said earlier, in most cases, the money that you'd spend on the setup and equipment and configurations would make you more money if you just mined. So this is really cool because never before have we had an international network of value exchange and information exchange that engineers can just sort of join and start building on top of, and they don't have to worry about what jurisdiction they're in or what version of software they're using or whether they're at scale or not. It makes the application layer very thin. It makes infrastructure much more seamless. And there's also a lot of values kind of posturing going on in software right now. There's a sort of a battle between the people that want free, open source, fair software versus the people that want, advertising-centric, more corporate software models. There is a sort of undying tech utopian vision that comes out of San Francisco that motivates a lot of this development and sort of motivates a lot of the peer-to-peer equality and fairness sort of aspects of it. So what does this do to legacy businesses? Well, like I said, I don't think that these blockchains compete with banking systems, but they will compete with ERP systems and other enterprise software suites. For anybody that has to buy enterprise software today, they get locked in pretty quickly, and it's very expensive. All the engineers that they hire have to learn, whatever Microsoft's particular thing is or Oracle's particular thing. This is going to make it a lot easier for engineers to learn a generalizable skill set that lets them work on large-scale software systems. And not get so locked in. And same thing on the company level, not get so locked in. It's also much cheaper when you don't have to pay for security. A cryptographically secured peer-to-peer network is impossible to break. Even if you had a quantum computer, it would take you thousands and thousands and thousands of years. So, I mean, imagine if any of you guys have IT internally at your companies, what you're budgeting to secure your systems. Imagine that you didn't have to spend that. That money could be put elsewhere. It's especially for large-scale companies. It's a huge cost recovery. So what will we actually see people using these for? I think that generally speaking, the kind of economic activity that's been happening on the app stores is going to move to this domain. The app stores have become a little bit intolerant of anything but the biggest corporate apps. So it used to be not that way. It used to be that independent software developers could build applications, put them on the iOS App Store, the Android App Store, and make some money. Now it's, the app stores are dominated by Facebook and Google and Tinder and all these other things. So you're going to start to see more mom and pop software businesses get built here. And of course, that's how the App Store started. That's how the Macintosh started, all mom and pop software developers. So this is certainly a phase. But I think these are the sort of the low-hanging fruit. A lot of it is kind of middle and back office stuff that if you run a software business, you certainly don't want to do, and you definitely do want to automate. So why do we have all these thousands of networks? Well, Bitcoin, I think, will eventually be seen as just a paradigm shift in the way we do a lot of things, but it's certainly inspired a lot of copycats. And the important thing to know, essentially, is that the way the industry is developed, Bitcoin is sort of the underlying for all these things. Bitcoin is extremely widely traded. The markets are very, very deep. There's really no, you could buy hundreds of millions of dollars of Bitcoin and not move the price. That's not the case for a lot of these smaller networks. And a lot of these smaller networks can't really stand alone. Bitcoin has sort of, the creator of Bitcoin or creators of Bitcoin made certain choices in the design rationale to make it super secure, but it's not optimal for things like retail, right? If you guys know, a block in Bitcoin takes on average 10 minutes, so you can't obviously have that in a retail setting. You need something faster. Transaction fees have also been a problem in the network, so you need something cheaper. The Bitcoin development group has addressed all this actually very effectively with a new version of the Bitcoin protocol, which is called Lightning. And it's the same old protocol, but it's configured in a slightly different way, implemented in a slightly different way to be much faster and much cheaper. But there is still room for these other blockchains. They still do sort of add specialized value in certain domains. So Ethereum is sort of a general purpose world computer. You can write any logic you want, and you can run it on the Ethereum computer, but you're going to have to pay for every computational step. And that's why nobody just writes, some infinite loop that locks up the network. Qtum, EOS, Neo, Cardano, Ripple, well, less so Ripple, but those other ones are sort of similar to Ethereum. They're highly extensible, highly programmable, but it's also very easy to make a mistake in an environment like that and accidentally lose money. So I think that the way things will develop moving forward is people will continue to use Bitcoin for sort of serious applications, but Bitcoin is very difficult to build with because it's so secure. I've heard it compared to building a house with a screwdriver. So people will really probably build most of their business logic on these second level chains like the ones I've mentioned here, but Bitcoin is always the underlying, or has been. So like I said, Bitcoin being gold, these other cryptocurrencies, the public cryptocurrencies, are sort of like banknotes. Pre-Federal Reserve, we had lots of different regional banks in the United States. They all issued their own notes. One interesting historical note, I think, is that the banks that were further into the country had a steeper discount on their notes in the cities than the banks that were located in cities, because it was harder to verify a country bank's gold deposits. You had to go all the way out there to redeem it or check what's in the vault. Sort of a similar thing is happening in cryptocurrency, where the teams that are really transparent and really well qualified and everybody sort of knows them, those coins are highly valued. The ones that are new entrants, or they're from China and harder for Westerners to reason about, tend to be cheaper, but they all sort of serve the same purpose, which is to be a sort of redeemable payment instrument that's easier to program with than Bitcoin. And I've made reference to this, but one thing that I want to pick out particularly is that Bitcoin's ledger is mathematically provable, and that this is not an accident. That the creator of Bitcoin was an incredibly accomplished and well-trained computer scientist, and probably someone who had really extensive experience working with monetary policy, because the idea that the ledger proves is just very impressive if you talk to anybody who's into mathematical proofs. The other thing that's interesting to note is that Bitcoin has developed a sort of arms race around the Bitcoin chips. More and more silicon manufacturers are looking at manufacturing these chips. I think that's really important for the network to be robust and to grow and to continue to get used. People need to know that there are data centers out there that have long-term investments in continuing to propagate the network. And there's also brand recognition. It's got this kind of, rebellious following to it. I don't know if you guys saw the guy that held up the Buy Bitcoin sign behind Janet Yellen a few months ago. There's definitely a countercultural aspect to it. So what should be taken seriously? So as I've been saying this whole time, I think Bitcoin and chains like it need to be taken seriously. I think blockchains also should be taken seriously, although they're not as exciting. The thing that's going to throw people off here is that open allocation governance looks like a total mess when it's happening. And it is a total mess, but that's sort of by design, and it does meet itself out over time, as you can see from Ubuntu and Apache and other successful open source projects. As I've said, I think these are machine-compatible Forex systems that are going to let people automate business logic at very little expense. This is really great for people that are running international software businesses with an international audience. So an example would be selling data, selling content. So let's say I'm a news site or I'm a data vendor. I should be able to sell small bits of data or information for like less than 25 cents. If you think about the way that Visa and MasterCard structure their fee system, I think it's like 21 cents plus 2% or 3% of the transaction. There's a lot of stuff in the world that can be bought for less than 21 US cents, especially when we're talking about a song or a number that might just be from somebody's database. So I think we're going to see really robust data and content markets develop. I think we're going to see the media be reborn. There's going to be a lot more grassroots media once people can pay in a seamless way. Media have tried paywalls in the past, and it doesn't work because it requires you to pull out your credit card and like buy a block of stories for $10 because you can't make a 2-cent credit card transaction. It's not going to be an immediate fix. I don't think the New York Times is going to roll out Bitcoin soon, but it's definitely going to happen. So I would say another thing that people are unaware of is how much trading volume exists in these coins. In New York, we have several trading desks that are doing over 2 billion each in volume every month, and that's mostly Bitcoin, although a little bit of Ethereum and other stuff. Although this is not a mature trading environment, people still have difficulty with custody, storing and saving, backing up private keys in a proper way. The private key is what gives you access to move Bitcoin. So you want, just like a safety deposit box key, you'd want to keep it very safe, but because it's a digital string of numbers and letters, it can be a little bit difficult for people who are unfamiliar with securing information on their own computer. So I think there's going to be a few years before traders wrap their heads around that. I think you're going to see the banks start to get cozier and cozier with Ethereum because they already see the promise of the internal blockchain and the intra-bank blockchain use cases. I think we've seen several banking consortia come and go around cryptocurrency. I think they'll eventually consolidate around Ethereum because it has a public chain and because it has a lot of public buy-in. I don't know if that'll necessarily work well for the banks or for the public chain, but it'll probably be tried. And as I made reference to earlier, I think it's worth watching some of these remittance networks. They could really change capital flows pretty dramatically, I think, in ways that central banks couldn't track. So for the people that have capital controls will need to watch this. For the countries that have capital controls will need to watch this carefully. The ones that don't will need to start watching this because it's data they need to be aware of. And finally, obstacles to growth. It's possible that Bitcoin just continues to be an object of speculation and that it never, the price never settles down to the point where people can anchor prices in their head in Bitcoin. If that happens, then it will be difficult for the people that I'm talking about, the software developers I'm talking about, to build their products and services. At some point, people are going to need to be able to anchor prices in their head in Bitcoin terms. Otherwise, something else has to change for Bitcoin to be useful. So it's possible that never happens. It's possible that this thing's just a roller coaster for years until people get sick of it. It's also possible that the companies that make these ASIC hardware chips just consolidate really quickly and sort of corner the network. And once people figure out that the network has been cornered, they're not interested anymore. I think if this happened, you'd probably see more attention to second-tier networks, younger networks. That's why there's 1,000 of them. They're all sort of waiting to be number one if Bitcoin kind of falls off the peak. And finally, who should get involved? What can you do about all this? I think everybody who's dealing with energy should be watching this. I think, I don't know if I say it on the next slide here, but there's a very tightly coupled relationship between energy, information, and physical value that's happening in Bitcoin, where you're taking electrons and you're turning them into something that is a limited, a scarce physical commodity. Humans have never been able to do that. Everything else that we've made that's digital can just be copied infinitely. So I think for energy companies who there's, in my mind, and maybe this is a stretch, they're dealing with a commodity that's sort of similar. It's an intangible commodity, but people need it. In many ways, it can't be hoarded. Cryptocurrency can be hoarded, but it's not wise, right? If you buy a bunch of it and hold it, you could lose all that money. Energy dissipates, obviously, in a battery. I think there's just for reasons that I can't fully articulate on the stage, there are reasons why I think this is going to become infrastructure on top of energy, sort of energy collection apparatuses or energy exploration apparatuses. Commodities traders should also, anyone who's comfortable trading illiquid commodities would probably have a lot of fun in these markets. And they are bigger than everybody thinks, so you can do large lot sizes if you're a trader. And anyone with an industrial facility that has a lot of power or cooling, or anyone that needs heat, because mining generates a lot of heat. At this point, there is an all-out an arms race for data center space, cheap electricity, cooling. Anybody who has sort of a sweetheart scenario where maybe they're running a hydroponic farm or they need heating for some reason. They're in the Northeast or Iceland or whatever. But this is actually Bitcoin mining, cryptocurrency mining in general it's not a hard thing to wrap your head around if you have a little networking experience. So I feel compelled to tell people, like, if you have space and you have interest, you should do it because it would probably work out well. And we can do questions.
Okay, Chris, let me get started with a few questions, and then as questions come in, I'll filter them through. But I guess just to start, and I'll ask Brandon, since you've been resting here. Since last year, what's been your biggest surprise?
Yeah, and can you guys hear me in the back? You guys hear me okay? I guess biggest surprise for us, we started our fund end of 2015. 2016 is when we closed, and we came and we spoke here, I guess March of 2017. It's how fast the market evolves, right? So when we were doing it, we started out as a venture capital fund. We thought we'd be doing seed investments in blockchain startups. During that time between March and I guess June, that's when the ICO market really started to heat up. So you had this entire ecosystem that was developing around fundraising or bootstrapping these open source companies. And you started to see billions of dollars flowing in that was, I don't know, it came as a surprise to everyone in the market. And so, you had this proliferation of new companies and protocols that were coming to market, and now it stands at over 1,500. When we were investing, I guess in March, there were probably only 20 that we were really looking at, and Bitcoin dominance at the time was probably well over 60%. So that was probably the biggest surprise over the last year. And it ended up being super profitable for everyone. And that's why you see this big rush of interest, right? Everyone has a yield, they head towards yield, and obviously cryptocurrency market, blew every other asset class away.
So, Chris, what was the biggest surprise for you over the last year?
I would say the presence of big players, big banks. In the headlines, I see banks saying, yeah, we're thinking about trading this. And then on the phones, we hear they are trading this, and they're just saying that they're thinking about it. And in many cases, they've been trading it for years. That was definitely a shock to me.
I'm not sure if you'd agree with how I phrased the question, so you can correct it. But as you look out 5 years from now, let's say, what do you think will be the biggest story 5 years from now? Will the bigger story be what I think of cryptocurrencies being this? Or will it be crypto assets more broadly being this? Or will it be blockchain-based applications most generally? Where will it be the bigger story 5 years from now?
I would say it depends on your perspective, but I think the biggest story is actually going to be cryptocurrency. I think you're going to start to see, I don't know if people have seen President Maduro in Venezuela launched an ICO for Venezuela. And he did it in a way that actually violated a bunch of WTO regulations around pre-selling oil that has not been taken out of the ground yet. I think this is going to be a disaster, and probably the Venezuelan people are going to pay the price. But it's going to lead people to look for something that is slightly more sane, but has some other of the same characteristics. That being like a Bitcoin standard or something similar to a Bitcoin standard. I don't think sovereignties will launch their own coins. It's too difficult technically, and the risk is too big. But I would say you're going to start to see these little sort of defunct economies like Venezuela and Zimbabwe start to pick this stuff up. We know for certain that North Korea has been building malware that mines Monero, which is a private cryptocurrency. And they've infected hundreds of thousands of devices around the world with this malware, and it's paying back tens of millions of dollars to Pyongyang in Monero. So these to me are the signs that it's sort of like what criminals do on the internet is mainstream like 10 years later. I think what criminal sovereignties do in the world economy is going to become more normalized and more safe. That would be my guess.
And I guess for me, I actually hope it's not a story. I hope that the whole cryptocurrency or crypto asset class becomes ubiquitous. And what I mean by that is that we don't even think about it. And I think that's happening sort of organically. Like when we were here a year ago and we asked the audience how many people own Bitcoin or a cryptocurrency, we'd probably only have one or two hands, right? And I think if I ask the audience now, I would venture to guess that probably 5 to 10% people at least own it, and probably well north of 50 to 60% know about it. And if you have bought Bitcoin or a cryptocurrency, then you understand how technical that can be and what that means in terms of buying it and then moving it to another wallet and all of the stuff that it takes to do that. But when you transact in different cryptocurrencies and that becomes easier and there's user interfaces and user experience that's better, then all the stuff that Chris was talking about with Internet of Things and how we transact in it as a digital currency, I see the world 5 years from now where that's that's where we're headed. That's where we're headed.
Let me read you a quote from a Harvard Business Review article just 2 years ago. And the quote goes as follows: "The technology most likely to change the next decade of business is not the social web, not big data, not the cloud, not robotics, or even artificial intelligence. It's blockchain, the technology behind digital currencies like Bitcoin." Do you agree with that? And I guess if so, why? Because we all heard about AI as being a huge thing that's coming over the transom, but this would make the case that blockchain is even bigger than that. So do you guys agree? And if so, why?
I do agree. Part of the reason I agree is that I don't think that, well, I think AI and machine learning, what we call ML, AI, ML, have been sort of oversold, overpromised. The truth is AI is really great in defense applications, like for making a missile that can hit its target with using a picture of the target. However, in sort of daily consumer use cases, it really breaks down. And the only place where I've seen, so we have IBM, HP Enterprise, other companies that are sort of pushing these machine learning services and AI services. And really what they're good for is marketing automation. And that's important because marketers are expensive. I mean, Fortune 500 companies spend like a quarter or more of their budgets on marketing. So that's important, but it's not as if it's doing your job for you, right? It's if anything, it's writing an email newsletter for you. It's writing some marketing copy in a way that sounds human. So I think part of the reason I'm so big on blockchain and cryptocurrency is I think that some of the other vessels for enthusiasm are leaky at best.
Mm-hmm.
Yeah, and I guess anecdotally for me, just looking at the life cycle for companies and how they're funded, I mean, I think it's been sort of widely accepted in the venture world that blockchain is sort of the next transformative technology, so to speak. So companies that are raising capital now are blockchain-based companies, and companies that are established, whether you're Overstock.com, whether you're what's Jack Dorsey's company? Square, you're trying to implement or incorporate cryptocurrency and blockchain. So, I guess I agree with that too. I mean, I think, for me, and I guess for both of us, we view cryptocurrency and blockchain as a paradigm shift. And as Chris was alluding to, we view it as sort of a premium internet. And even within that, it keeps evolving and it's speeding up. So, behind the scenes, these teams are really working on phenomenal things, and those that did raise with ICOs have a war chest of capital because of the price increase in Bitcoin or Ether. So they have a long runway that they're able to pay developers to continue to build this out, and so I think we'll see some pretty exciting things over the next 3 to 5 years.
Just commenting from where I sit on it, there's many parts of the story that is easy to be skeptical about and kind of worried about, and read all kinds of headlines that kind of make you sort of take this with a big grain of salt. Now, on the other hand, as I understand it, I think one of the great beauties and the future powers of, I'll say, blockchain-based applications going forward is it's the ability to kind of disintermediate a lot of things that in the past have required complicated, expensive, intermediated, decentralized systems. So think about medical record keeping. I mean, all of us have the problem right now when we go see different doctors. It seems like every doctor you go into, you got to go through the same set of forms to fill out to provide your medical history. Or think about real estate record keeping. And when you buy a property and you have to go through title insurance, see who's really owned this property over a period of time. That I think those are some of the places where blockchain-based solutions could basically take out a lot of cost in a system to make it much more simple and streamlined.
Yes.
And so I think for many of us in the lay world, you think about it that way, say, wow, that could really be a big deal. You can see where the benefit is.
Yeah. So here's why I'm more optimistic about sort of like software services and some of the things that I mentioned earlier, like content and selling data for very small amounts, maybe in an automated way. The reason I'm more interested in that than in the scenario you described, Bill, is that in many cases, especially with the medical industry, the last mile is the hardware vendor that makes, let's say, the MRI machine. So take MRI machines, for example. Hitachi is one of the biggest MRI manufacturers. They make a lot of hospital equipment. They also make the PC that sits next to the MRI and holds all of the MRIs. All that software is completely proprietary. All that inter-hospital networking between the MRI, the computer that is central to the hospital that's getting data from all the other MRI machines, that's all Hitachi software. So what's their incentive to join a public blockchain where they essentially become just a one player in a bigger ecosystem that they don't own? I don't think they'll see a reason to do that right away. But I think another generation of technologists will pass that will probably think about things in a different way. So I think for some of the highest value things, like in the medical industry, I think we're actually further away than people expect, maybe even 25 years. But I think in terms of what we see and do on the web, I think Brandon's premium internet analogy is right on. That's it. We have the internet. We need a premium internet that's not full of malware and spam and hacking and porn and like all kinds of other nasty stuff. We need an internet that's like proper for business, that can be sort of seriously relied upon as infrastructure without every single stakeholder having to pay to fortify their little spot on the network. That's not sustainable.
Let me ask one follow-up question, and we've got some good questions which we're going to move to in a moment. But when talking to a portfolio manager, I'll put it that way, one of the best ways oftentimes to find out what they're thinking is not by listening to what they're saying, but watching what they're doing. Finding out what is in their book. What are they buying? What are they not buying? What are they doing? What are they not doing? And so I'm curious, when listening to the two of you, you've started this business a few years ago. You built a mining operation in New Jersey, 10,000 square feet or so? It might be bigger than that now. That's been part of it. The fund launch that you've raised money from investors on. And as I understand, I think the strategies you're investing in, or at least have raised the money with the expectation, this is the range what you're interested in, includes cryptocurrency accumulation, trading, mining operations, and crypto network acquisitions. So this whole space is moving so fast. What you think today is maybe a little bit different than what you thought 6 months ago in terms of where the value is and where it's not. And I guess just maybe talk for a moment about kind of where are you going with your business, and frankly, where are you staying away from, which is maybe as interesting as anything.
Yeah, I guess I'll kick it off. Well, true to our company name, we do iterate sort of with the market. And one of the things that we wanted to do when we left our respective venture capital jobs was to really change how that was done, how financings were done, the companies that we chose and what we thought was interesting. And to a great degree, that's been accomplished, right? I think even venture capitalists are now coming to us to see sort of what we're thinking or what we're involved in. But I guess to answer your question directly, we don't view ourselves as just a hedge fund or a venture fund. We view ourselves as cryptocurrency miners first. We think that miners are the ones that control the network and are the actual stakeholders. Right. So when we put this overhead cost of building out a data center, buying the mining hardware, that becomes a speculative play in terms of what we're actually mining. That the stuff that we're actually mining needs to be able to be liquidated to pay for for some of those upfront costs. So. So we're miners first. On top of that, we have a layer. We try to be full stack. So the stuff that we trade is based on data flows and things of that nature that we generate from the mining. And Chris is the CIO, so he can tell you.
Yeah. So.
Well, you're the chief compliance officer, right?
Yeah, I do a lot of stuff.
We're both chiefs of everything at this stage, until we hire more. But actually, we do have 7 people now. So we are starting to specialize. I think. Where's the business going? Miners are, to your point, Brandon.
That's the base.
Miners are the network owners. So it's like being a major shareholder or a pension fund in the equities markets. Whereas if you're a small shareholder, you're more like somebody that just owns a Bitcoin. Like you can participate, but your ownership is symbolic at best, and maybe you get some profit out of it. But in order to invest at scale, especially investing other people's money, we couldn't be passive that way. That I don't think is the right position to be in, especially if we have strong opinions about how these networks should operate, and we do. So, I don't want to say that we'll ever actively manage a network, but we are managing the managers of the network, so to speak, and because we have ideas about what enterprises want from these networks. We see them, we see the gap between what the networks are today and what a lot of the players in technology want from the networks. So you'll see us continue to mine, continue to make markets in the coins that we mine. We launched an OTC desk this year that's already doing great monthly volume, mostly in Bitcoin, but more and more in other coins. So I think that's how it'll develop.
So here's an easy question following up on that is let's see. Just lost the one. Oh, here it is. What is the current cost to mine a Bitcoin today?
It depends on where on Earth you are. On average, it's about 5,000, I think $5,800. In the U.S., it's a little higher than that. Certainly, in other places, it's cheaper. The most expensive, the cheapest place actually to mine a Bitcoin is Venezuela. You can mine one for, I think, $3,500. The most expensive place is South Korea, where it would be something like $12,000 or $13,000, $14,000 to mine a Bitcoin.
So the Bitcoin value is, say, roughly $10,000?
Yes.
Right? So the cost to produce is maybe about half that?
Yeah, I mean, I think what you see, the $10,000 figure is sort of an average cost of production in major industrialized economies around the world. So it's sort of something between Brazil and South Korea.
Got it. Why and how is there so much? Why is there so much cyber currency theft? How safe is blockchain?
That's a great question. So these things, I made reference earlier to private keys that let you unlock your Bitcoin. Your Bitcoins are not owned by you. In fact, there are no coins. There is, not to get too matrix on everybody, but these things they don't exist. They're not, when you're sending Bitcoins, you're not actually transmitting any data from place to place. So nothing's being sent, not even in a digital sense. What you actually have is an account, and your account has an integer balance, and the balance is a positive integer, what we call in programming a uint, an unsigned integer. So you have a positive number, that's what you own. And how do you change that positive number? Well, you have to have this private key, which lets you send your positive number to somebody else. And if you lose that private key or you store it in a silly place where someone else can see it or take it, you're going to lose your funds. I think most of the hacks that have been happening that hit the headlines are around people that are doing ICOs. They're building them on Ethereum. They're building a crowdfunding, what we call a smart contract on Ethereum, which is essentially a little program that just takes in money, takes in Bitcoin or Ether, and sends out your proprietary token. So let's say I launch an ICO and I say, I'm going to run my own casino and these are my casino chips. Send me Ether and Bitcoin and you'll get back a bunch of my casino chips and now you can play games in my casino. If I don't program that contract correctly, someone, because blockchains are public, some better engineer than me could look at this contract, find a loophole, exploit it, and take all the money that I raised in that. That's happened a number of times. So it's user error, unfortunately. Or fortunately, I guess, for the network.
There's a related question, which might repeat a bit, but you might see if you have any further response on it. It says, you hear about people losing Bitcoins in their account, or maybe wallet. Is that because of poor management of crypto keys or something else?
Yeah, it's usually poor management of crypto keys. They lose the information.
You touched on this in your comments, but I want to come back to it. The security at the core is relying on the crypto technology, I'll call it, to maintain security. In today's computing world, that's true. But if you get into a quantum computing world, as it ultimately develops, do you worry about that quantum capacity developing to the point where current cryptography is not going to be as safe as what we now think it is?
Well, I'm not a cryptographer, but I will say that there's really two kinds of encryption that are commonly used. One is hashing, which is like a one-way encryption. So you take some information, you hash it, now it's a mess of letters and numbers, and you can't turn it back. This is actually how your Wi-Fi router works. When you punch in your password on your phone, it's not actually sending the password to the Wi-Fi router to see if it's correct. It's hashing it, and then it takes the hash, which doesn't look like anything, it's certainly not the password, and compares it to the hash that's on the router. And if it's the same, it connects you, and if it's not, it doesn't. So this is already the way that computers expose private information in an untrusted scenario to get it to another computer. This is already in use. Encryption is doing this process but making it reversible. So I send you an encoded message, you can decrypt it with a special key that you have, and you can read the message. encryption is a lot harder to protect against quantum computing, but hashing, you can hash things to your heart's content. I mean, you could have any number of quantum computers, and you just add another round of hashes, and now you're another universe age away from finding the answer. So I think for these networks, which rely almost entirely on hashing, at least for the data storage part of the network, it's not an issue. Absolutely not an issue.
We are getting the famed red card back there, so we've run out of time. For those who submitted questions we did not get to, I apologize. I think you guys will be with us at lunch, right?
Yep.
So if you can, grab Chris and Brandon and ask your questions directly. And Chris and Brandon, thanks very much.
Yeah, thanks for having us.
Appreciate it.